One of the questions I get asked a lot is, what is a fund? And I think the best way to describe it is in the stock market, you can buy a single stock like an Apple or Tesla or IBM or whatever. And if that stock goes up, you do well. If the stock goes down, you do horrible and you ride this ride. Versus in the stock market, you can do what most people do and most retirement funds do, which is called a mutual fund, where you're really buying a bundle or a bucket of a bunch of different stocks. There might be a little Apple in there, a little IBM, a little da-da-da-da-da. And so instead of it doing this, it's a little more steady. It's the same way with a real estate or a mortgage fund, which is what we have. So at Precision Capital, as a general partner of a couple different funds, what we do is, as investors invest money, your money goes into that fund. And that fund may own 100 loans, 200 loans, 300 loans. And so you own a little piece of those loans. So if one loan were to suffer because of a pandemic or whatever the reason is and not perform as well, other loans are performing. And so your return stays pretty steady. You don't have this up and down. So that's really the difference between a fund and just owning one single mortgage. Same with back to the stock market. It's the difference between owning one stock or a bundle of stocks in the mutual fund. So the fund, you're putting your money in, you have a professional general partner, which is myself, that's deciding which loans we're going to buy that you and the other partners, called limited partners in a fund, own, so that we're making sure that we're aggressive enough to get good returns, but conservative enough to protect everybody's investment.